Guys, on Friday, the economy delivered what should have been good news to all of us. We got a stronger than expected jobs report. Right after that jobs report came out, investors immediately started selling off stocks. Now today, I'm going to show you why the good news of a good jobs report that should have pushed the stock market higher ended up sending the stock market lower instead. Now, let's start with what actually happened. Economists were expecting somewhere between 80,000 and 90,000 new non-farm jobs in May. Instead, the economy added about 172,000 new non-farm jobs, according to the jobs report we got on Friday. Now, that's double what was expected. And it gets even more interesting. Hear me out. March and April jobs, new jobs, they weren't revised lower, they were actually revised higher. So March and April, new jobs went up too. Now, if you don't believe these numbers, let me know in the comments below. But here's the deal. Whether you believe the numbers or you think they're faking the numbers, that's really up to you. But we can only discuss what the numbers are reporting, okay? So March and April job numbers increased. That means the last 3 months of new jobs being reported were stronger than what many investors thought. Meanwhile, what happened to unemployment, the unemployment rate, it remained at 4.3%. That's exactly where it was the previous month. And it has now remained somewhere between 4.3% and 4.5% for nearly the last year. So unemployment has been steady right in that low unemployment range. In other words, the labor market is not getting weaker on paper, at least, like we thought it was, based on the numbers that they're reporting to us. Now, before we go any further, let me be clear about something. This economy is not totally booming. I don't care what you see in here. The numbers tell us that things look pretty good, but there's also some issues. The labor market is strong, but that's not the same thing as saying the whole economy is strong. Real GDP, now when I say real GDP, I'm talking about GDP adjusted for inflation, has grown about 2%. Consumers are becoming more cautious though. We know that because consumer sentiment reports show that. Savings rates for average Americans are going down, meaning that people are saving less money. That big time spending that we've seen over the last 3 or 4 years, that's not happening really no more. And many households, hear me out, are still feeling the pressure from the higher prices that we still see. That's the inflation. So what we're really looking at, guys, is an economy that feels like it's growing, but it's growing more slowly than people realize. That's what makes this environment so difficult at this point. See, the economy is strong enough to create jobs. Cool. Yay, we got new non-farm jobs, a bunch of new non-farm jobs. But the economy is not strong enough to completely escape our concerns as consumers about inflation. And this Middle East conflict that's causing the cost of oil and gas to go up, right? That's a problem too. Now, if you're like most people, you're probably wondering something. Why would investors be upset about this strong jobs market? More jobs sounds good. More hiring sounds good. A stable 4.3% unemployment rate sounds good. And normally you'd be right about that. All that stuff sounds good. But the stock market went down this past Friday because the stock market is not reacting to today's economy. The stock market is reacting to what today's economy means for tomorrow's interest rates, right? Remember, the stock market is always looking forward, and that's really where everything changes. See, for the last year, investors have been hoping for lower interest rates or cheaper money, right? And I've been talking about it here on YouTube for the last year, right? We're going to see some lower interest rates coming up. The assumption was pretty simple, okay? As the economy slowed down, inflation would continue to fall at the same time. That's what we were all thinking. And the Federal Reserve would ultimately what? Keep cutting the rates, right? That was the story really just 6 months ago, okay? We were all expecting interest rates to come down. But Friday's job report, that was a good jobs report, has challenged that whole viewpoint because a labor market that keeps creating a lot of new jobs is not slowing down. That's just a fact, okay? Now let's talk about the Fed. the folks who are responsible for the money supply, okay? Remember the last Federal Reserve had an inflation target, and let me say this. I say the last Federal Reserve because we just got a new Fed chair, right? And things could change. But the Fed before this new Fed chair had been wanting inflation down to what? 2% for the last 4 years. But inflation never got to 2%. And in fact, inflation recently has started moving back up in the wrong direction, higher inflation, which we don't want. The last headline CPI inflation showed that inflation was back at 3.8% again. Now, it's important to understand that not all inflation behaves the same way. Headline inflation that was 3.8% or near 4% was going back up. But core CPI inflation, which removes food and energy from the equation, is still closer to about 2.8% or 2.9%, which is better, but it's still above the old Fed's target of 2%. And the cost of things like rent and housing and transportation and other services, they continue to remain elevated as well. And we know again that gas and fuel prices have increased because of the Strait of Hormuz, the issues going on in the Middle East, supply routes have been cut off and all that. And all of those costs eventually show up in the prices that we pay as consumers. Now, at the same time that all this is going on, you got a labor market that's still strong. And that's the problem, especially for the Fed. Because here's the deal. People with jobs do what? They spend more money. And yeah, we've seen some layoffs and some pockets of hiring freezes in different industries or sectors. But for the most part, businesses continue hiring people. Consumers continue buying stuff. And all of that means what? The demand for stuff remains strong. And here's the deal. A strong demand makes it harder for inflation to go down. Let me illustrate it like this, guys. If you have a hat company and you sell hats and everyone is working and has a job because the job market is strong and the unemployment rate is low and everyone has money to buy your hats from your hat store or your hat manufacturer, are you going to be lowering the price of your hats? Probably not. In fact, when the demand for your hats is high because everyone has a job and everyone has money, you'll probably be raising the price on your hats, right? That's inflation when demand is high. And right now, lots of people are working. Lots of people have jobs. Businesses are still hiring. Businesses are still spending and expanding. And all that is because demand is high. And so you don't see prices go down when demand is high. You see prices go up when demand is high. So a strong jobs market means a strong demand means prices may continue to rise. So the Fed cannot come through and say, oh, we're going to go ahead and lower the Fed funds rate and make borrowing money cheaper when demand is already high. See, everyone having money and jobs keeps demand high. And the result of that is simply prices go up. Just like if demand was high for your hats that you sell, you would be raising the prices on those hats. That's why sometimes the very thing that's good for workers, a strong jobs market, is the exact same thing that makes it harder for the Fed to lower the Fed funds rate, because that would make money cheaper to borrow and people would spend more. The Fed don't want everybody spending more if jobs are strong and inflation is already going back up. So this past Friday's jobs report, it didn't scare investors because it was a weak one. No, it scared investors because it was a strong jobs report. A stronger economy means inflation may stay higher for longer because demand is higher. Think about what changed, okay? Just a few months ago, investors were asking, hey, when will the Fed cut rates? Maybe 3 or 4 or 2 or 3 rate cuts this year in 2026? Now, many of those same investors are asking this question. Could the Fed raise rates again? And why would the Fed raise rates? To slow down the spending. So why would they want the Fed to slow down spending? To stop inflation. That's a massive shift in thinking from where we were just a few months ago. So you got some investors who think that the next move that the Fed is going to make may not be to cut rates, but could be a rate increase. Think about how different that conversation is from where we were just a few months ago. Then, let me throw this in there too, because this is important. You got bond yields that are starting to rise too. Now, the 30-year Treasury bond yield moved back to nearly 5%. I think it's somewhere around 4.99% right now or something like that. Now, think about this. For years, guys, investors had almost no alternatives to the stock market because the bond yields were so low. So if you wanted better returns, everybody did what? They bought stocks, right? Because stocks might be 8 or 9% return where bonds were giving us 1 or 2% return. And everybody was frowning on bonds for a lot of years. But today, you can earn nearly 5% from a government-backed bond with way less risk than the stock market. And that changes the equation. Some investors, what they start doing is this. They start moving their money out of the stock market and into the bond market. Not because they're predicting some type of recession or a big old crash, but because bonds are a safer investment. And a safer investment becomes much more attractive to some investors, especially when you're talking about bond yields in the 4% to 5% range. Now, all of this doesn't affect just the stock market, right? I know we got a dip in the market on Friday, but it affects mortgage rates. It affects car loans. It affects the rate of interest that a business has to pay when they want to borrow money to expand their business, right? It affects us as consumers. The average 30-year mortgage remains right now around 6.5%. And many Americans have been sitting around waiting for mortgage rates to fall. But if inflation stays high and the Fed doesn't lower the Fed funds rate and bond yields stay high, so do mortgage rates. All this stuff is tied together. So those lower mortgage rates that a lot of people have been looking for, which are tied to the 10-year Treasury yield, may take longer to arrive. It may be 3 or 4 years down the road before we see mortgage rates in the 4s and 5s. Who knows? Now, I've talked about a lot of stuff, but let's talk about what we should be doing, because I never want to leave a video without giving us, regular old consumers and investors, practical things that we can do. Now, first thing is this. Don't panic. Yes, the stock market dipped on Friday, even though we had a good jobs report. Because listen, the labor market, for the most part, remains pretty healthy. People are still working. Companies are still hiring. We're not in a recession. We're not even really near a recession. Second thing is this, after you don't panic, stick to your investment plan. This is why you need a written plan in the first place. Ultimately, interest rates are going to change at some point. Inflation, whether it goes up or down, it's going to change at some point. The stock market, yeah, we had a low on Friday, but it's going to change and fluctuate also, right? Think about it. The stock market has had basically about 108 trading days so far this year. And the S&P 500 has closed at a record high on 24 of those days. That's about 20 to 25% of the time this year, we've got record highs in the stock market, right? So the stock market is doing fine. So stick to your plan. Keep on dollar cost averaging, okay? Now, the third thing that I want us to be aware of is pay attention to bond yields. The bond market is bigger than the stock market. The bond market is also more complicated than the stock market. But when I say pay attention to bond yields, I mean the returns of some of the safer type of investments that are out there, like your treasuries, your money market funds, your high yield savings accounts, right? There's opportunities to earn some meaningful returns on some of those types of investments that we've all kind of scoffed at over the last 10 years or so. And finally, we all need to keep watching inflation just as close as we watch the stock market, because inflation, it may be the most important factor that's going to determine what happens next. The headline CPI report and the core CPI inflation report. If the next inflation report shows that inflation is moving higher again, especially as high energy prices work their way through the economy, that could reinforce the idea that we'll have higher for longer interest rates from the Fed. Here's the important takeaway for all of us. The lesson here about the economy right now and the dip in the stock market on Friday is not that the economy is strong. No. And it's not that the economy is weak. No. The lesson here is that the economy is sending us mixed signals, and our job is to interpret those signals. Jobs remain pretty strong. That's good news. Inflation remains stubborn, but we got another CPI inflation report coming soon. And of course, consumers, we remain concerned about higher inflation and prices. But growth, the growth of the economy, remains fairly good. And that's good news too. So good news in the economy is not always good news for the stock market. You got to be able to separate the two and interpret what it means. And right now, the stock market thinks that a strong labor market could mean higher interest rates for longer. And if you couple that with strong bond yields, that's why we saw a dip in the market on Friday, despite the fact that we got good news from the jobs report. That's why the good news that should have lifted up the stock market, hey, good jobs report, actually ended up on Friday sending the stock market lower instead. Listen, if this video helped you understand what's happening in the economy just a little bit better, do me a favor and drop a comment below and let me know. And share this video with somebody who you think needs to hear it. Listen, most people spend their lives reacting to headlines. Good jobs report, bad inflation report, the market is up, the market is down. But wealth is not built on reacting and emotions. Real wealth is built by following a real plan. That's exactly why I created the 4-step financial reset to help working adults take control of their money no matter what the economy is doing. The link to the 4-step financial reset is in the description box below. Join us for the next one. And if you're just getting started, just grab a copy of my book, Manage Your Way to Millions. All of the links are in the description box below. Hey guys, the best person who's going to take care of that old you is the young you. Until the next video. Peace.